Right. Yeah, there's so many, I used to say, so many long-term charts were effectively broken starting in 2020. They just didn't have a lot of relevance to what had come before. Now, I guess bringing it back to what the markets are trying to digest right now, you've had a significant reset in the first half of this year, whether it is valuations, economic expectations, sentiment, all the rest of it. What do you think that means for the risk-reward in the market going through the rest of the year?
Well, one thing to keep in mind is that the market, too, has been returned to normal. Bond yields right now from 2 years to 10 years in relation to their break-even rates, their respective inflation expectations, are back either equal to or above average since 2010. That is, most of the rate market is fully priced for what they expect from inflation right now. That hasn't been the case till recently. The stock market, for the first time in this recovery on an S&P 500 basis, is below average PE multiple forward earnings or trail earnings since 1990. So they're in better balance overall. But I think at this point, Mike, this stock market has got to get an inkling that the Fed tightening cycle is ending before it's really going to sustain a rally. But I think we're a lot closer to that than you think. If I look at the break-even rates in the bond market have been collapsing here of late. The 1 year break-even rate is now down to 4.3%. It's fallen 2% in the last three months. If it does that again in the next 3 months, it'll be at 2.3%, well within the Fed's normal 2% area of expected inflation for 1 year forwards overall. Right. You know, and you look at, I kind of look at the Fed, you know, taking directives from the boss. And right now, the boss is the economy and the bond market, and both are telling it it's got to wind up its tightening program. Inflation's rolled over, growth is slowing, bond yields are coming down. There might not be a Fed put, but there's been a bond market put of 50 basis points now from the 2 year to the 10 year recently. And I think the bond market and the economy is going to put more and more pressure on the Fed to stop tightening soon. So it may quit at 2.25 or 2.5%. And if the stock market picks up that we're getting close, we could have a nice rally yet this year.